How long have you been trading, and when did it become profitable? How did you learn to trade, and what resources did you use? Today I'm going to be answering 10 of the most common questions that I get about trading. Some of these answers you might have heard before, and others might be brand new to you. However, it often takes multiple times in order to reinforce a concept. I know I had to be taught several times some of these things before I really grasped them. So do your best to really take in this information, write it down wherever you need to, and make sure you fully understand what I'm saying. Question number 1. How much do you need to start trading? What's the minimum amount I should fund my account with when I'm first starting off? First off, if you're asking this question, the answer is probably 0 or a very minimal amount. Now, I know there are high fees when trading some assets, and if you're choosing something that has a dollar-based fee, you're probably going to want to start off with paper trading instead. If you don't mind switching to another asset for now, or maybe you'll love it and stick with it, Forex has PIP-based fees. This means that no matter what your trading account is, the fee is essentially percentage-based. So if you're targeting a 20 pip profit on a trade, for example, it might only need to run 22 pips from where you enter to cover that 2 pip spread fee. Another option is crypto, which has percentage-based fees. Now, 1% would be extremely high, but just to use it as an example for some easy math, if you have $100 and you're entering a trade with your entire portfolio, you would pay $1. If you have $10,000, you're going to pay $100. So it doesn't really matter what account size you're starting with. The important thing to keep in mind here is that you're likely going to lose whatever you start with in your account, or at least a majority of it. So whatever you decide here, that number should be comfortable to you. Consider the money gone that you're starting with. If you're funding a $10,000 account, make sure you're okay losing $10,000. Trading is not easy, and it's going to take you time to really grasp the concept and start winning trades. If you're not okay losing any amount of money, or the fees in your asset class are too high, as I was mentioning before, start off with paper trading. It's not the exact same thing as trading with a real account, as you have a lot less emotions tied into it. However, the concepts and strategies can still be developed in paper trading. Question number 2. What strategies do you use when trading? Now, I can tell you that I've tried pretty much every strategy out there. I've tried all the indicators, all the tools, I've thrown them together, combined them, even tried to develop my own indicators by coding some out. However, I ended up with 2 different strategies that I really like to use personally. The first one is a simple support and resistance strategy. All that means is that I'm drawing lines on the chart that have been super responsive in the past as either support, resistance, or ideally both. And furthermore, to throw things onto that chart, I'll throw on a Fibonacci and look for some common ratios such as the 50 or the 618. If you want to see more about how I use the Fibonacci tool, I've already created a video on this. I'll link it in the top right corner right now for you to watch after this one. The second strategy I really like to use is Elliott wave theory. Now, Elliott wave is pretty complex. It took me a long time to really grasp all the rules and guidelines that I must follow when using the strategy. A huge reason for this is because there's really no great resources in terms of videos. There are a couple of books I used, which I'll get into later in this Q&A, to learn Elliott wave. However, I'm a pretty visual learner. I like to see videos. As a result, I also created an Elliott wave tutorial series. Right now, this is 5 parts long and over an hour of content. If you're interested in learning Elliott wave, I'd recommend you buy the books that I'll suggest later on, as well as watch that Elliott wave tutorial series. Again, I'll link part 1 in the top right corner right now. Question number 3. What time frame do your strategies work on? The quick answer to this question is every single time frame. It doesn't matter whether you're zoomed into a 1-minute chart or a 1-day chart. The technical analysis strategies still work across all of them. Now, personally, I use my support resistance Fibonacci strategy when I'm day trading or on a lower time frame. That's because I can easily adjust where I'm drawing the lines of support and resistance to account for new price action in the market. When I'm trying to plan things for long term, that's when I use Elliott wave theory. Because it takes a lot of thinking, a lot of planning, and a lot of rule and guideline following, it'll often take me an hour or multiple hours to get a full Elliott wave count on a chart. As a result, trying to do this in a 1-minute chart is extremely difficult and would require a ton of time. So here I'm zoomed into a 15-minute chart on the S&P 500, and I'll just show you a quick example. I'll pull a Fibonacci from this top peak all the way down to this peak right here, pull it over, so here to here, And you can see this price tags the 618 right on. So had I been trading the S&P, which I personally do not, it would have been a very obvious short to take right at this zone. And in the Fibonacci video I was telling you I created earlier, I tell you that the 618 is one of my favorite spots to take a trade, whether that's short in a market that's going back up like this or long the other way. So now, just in case you don't believe me about that also working on a daily chart, I'm going to show you an example. Only a couple months ago, we had a massive retracement in the S&P, going down from about 3,400 all the way below 2,200. This was roughly a 36% drop in the market. So of course we're in hindsight, but let's try to figure out why we stopped where we did. Let's use a Fibonacci again and just pull all the way from the lows back in June 2010 and then click back up to the high we had. Now I was just saying that the 618 is my favorite spot to take a trade, but you'll also remember I mentioned that the 50, which I have as this red line, is my second favorite spot to take a trade. So we're pulling this Fibonacci tool over a period of almost 10 years and look exactly where the price came down to, within a few dollars of this red 50. And on a related note, question number 4. Do your strategies also work in another market, such as Forex, crypto, options, etc.? And again, the answer is yes. All technical analysis applies across all markets, across all time frames, and they happen over and over again. This is a result of who is trading these markets. There are algorithms programmed to buy and sell at specific levels, and we as traders are trying to do what they are doing. So from the previous example I showed you, there are obviously algorithms that are buying right at that 50. So instead of taking my word for it, let me just show you it in another market. Here's the euro to the dollar, a Forex pair. I'm going to take a fib retracement and pull it from this high up here in May 2014 all the way down to this low in January 2017. And just pulling over, look where the price came up to. Just a couple pips shy of being right at that 618 once again. Question number 5. Why don't you use more indicators and tools in your chart? So as I was saying earlier, I can tell you that I've tried out every single indicator. If you click through your options on TradingView on the left hand side, you'll see some of the things that I've played around with. And a lot of them are still on my favorites tool up top. And again, I've even tried programming my own trading indicators. You can see this one titled here, Does This Work? And TradingView will actually allow you to run this and backtest it over a certain period of time. While it's been a fun time learning all of these different indicators and tools I can use, through my countless hours of backtesting, along with many failed trades, many blown accounts, and just a ton of failure overall, I can honestly say that my studies have shown, via logging my trades, that a simple support, resistance, and Fibonacci strategy works best for me when day trading. And similarly, in a long-term aspect, I don't think there's any indicator or tool in existence that works better than Elliott wave theory. Those who hate on Elliott wave probably just didn't take the time to learn it. It's not simple, and therefore most people will just give up before they can see the results of it. And most importantly, I like to keep my charts clean. Price action is extremely important, and when you have tons of lines all over your chart, you can't see anything. I want to see exactly where the price was, when it was, and where all of the peaks are, without having to look for more than a few seconds. Question number 6. How do you know which pairs to trade? Now, this question definitely varies across the different asset sets, and personally, I trade crypto and Forex. So I'll tell you my answer for each of these. In crypto, I mostly trade the Bitcoin pairs. That means that I'm accumulating Bitcoin. My crypto portfolio always sits in Bitcoin when I'm not doing anything, and I'm trading the pairs that are against Bitcoin. For example, BNB BTC or Binance's coin to Bitcoin. When I'm making these BTC pairs, I'm looking for about 200 to 300 times my personal trading volume as its daily 24-hour volume. So what I mean by that is, if I'm trading a 1 Bitcoin portfolio, I want to make sure that the pair has had at least 200 to 300 Bitcoin volume in the last 24 hours. This is to make sure there's enough volume and volatility to get in and out of trades whenever I want to. I found this number works best for me. In the second market I trade, in Forex, well, volume really isn't an issue. In Forex, I just trade all of the majors and minors. Question 7. How did you learn to trade, and what resources did you use? So I'll say that I got extremely lucky when I decided to get into trading. As a quick side story, I was basically just trying to get money into a poker account, as at the time I loved playing online poker. The best and quickest way I found to do it was through cryptocurrencies, or Bitcoin. So back in about April 2017, I bought some Bitcoin, and you can see That's the little blip in the market right here. And by the time I actually went to send it into my poker account, the value had grown by about 25 to 30% without me doing anything. Honestly, I was pretty confused because I didn't know much about trading at all, but I saw this as a huge opportunity. I actually stopped playing poker for the most part right about then and started practicing more and more with trading. Now, I got pretty lucky. As you can see, the market absolutely exploded when I first started trading. In my first 8 months, Bitcoin went from about $1,000 when I first bought it all the way up close to almost $20,000. Now, there were a couple advantages and disadvantages of joining right in the middle of a massive bull run, one of the largest ever seen in such a short period of time. To start off with the advantages, it was practically impossible to lose a trade. No matter when you bought, you really didn't need to use a stop loss. As long as you just held until the market was higher, you made money. It was really simple, and 90% of traders were making money. This was awesome to start off with because I didn't know about controlling my risk. I didn't know about starting with a small portfolio, and so essentially I got really lucky. The major disadvantage of joining at this period of time was that I had no idea what to do when this market started going downwards. So we hit the peak and there was a massive dip, almost 50%, and all I could think about was buying more and more, since all I had experienced was the market going up and up and up forever. And through all of 2018, where the price went from about that $20,000 mark all the way back down to the low 3,000s. During this period, I gave back almost my entire profit. Finally, at the start of 2019, I realized that I had just sat through a crazy market cycle. I got to experience one of the craziest bull runs in history, followed by one of the craziest bear runs in history. I took a step back and realized how much I was able to learn over that period of time. So in summary, I really learned trading mostly by just diving into it. I got extremely lucky when I started and failed for an entire year after that. Once 2019 started, I took what I learned, wrote a ton of things down, and started reading a lot. One of the top books that was recommended to me at the time was called Trading in the Zone by Mark Douglas, and this is still the best trading book I've read to this day. I'd highly recommend it, and you absolutely have to read it. The next step I took, actually in the middle of 2018 when I was just failing over and over again, was to try and join a bunch of different paid groups. Now, I can tell you that almost none of these were helpful. A lot of them were scams, a lot of them just gave me calls, and I really didn't learn anything from them. However, I want to highlight one of them, and that's Trade Devils. I was a member at Trade Devils for over a year, and they introduced me to Elliott Wave, as well as the Golden Zone and many other great concepts. They also have a YouTube channel with hundreds and hundreds of hours of amazing content that I studied and watched over and over again. And when I had been with them for a long period of time, I was recommended Frost and Prechter's Elliott Wave Principle book. This is by far the best Elliott Wave book in the market. If you want to learn and study Elliott Wave, you have to buy this book and read it as well. The other great resource I read for Elliott Wave is just ElliottWaveInternational.com. These are the people who actually regulate all of the rules and guidelines and make sure they're always kept up to date, where small changes could be made over time if necessary, and they have all of the rules and guidelines on their site as well. And finally, the last resource I really like to use is an Elliott Wave cheat sheet made by someone named Crypto Mento, and it's available on Amazon. Now, don't be thrown off that his name has crypto in it if you don't trade crypto. It's really meant for Elliott Wave, which again can be used across all assets, all time frames. It's cheap on Amazon, and I use it as an everyday guide for reminders of rules and guidelines that I might slightly slip up on. So most importantly, I practiced, I failed, and I just kept going over and over again. I had many individual trades over the last 3.5 years where I had lost 50% or more of my portfolio. These are incredibly painful, and if you don't start to manage your risk properly, you're likely going to experience them too. Question number 8. How long have you been trading, and when did it become profitable? So I mentioned this one in the previous video, that I started trading in about April of 2017. I spent a majority of 2017 just getting lucky, and the back half of it really starting to learn a little bit. However, still really just getting lucky with crypto. I was quite profitable in 2017, as I was saying, who wasn't that was trading crypto? And I mentioned that in 2018, I lost most of my profit. I increased the size of my portfolio through 2018 and just kept losing over and over again. Finally, in 2019, I felt like I learned a lot, and throughout the year, I was up and down in my profit. I'd have months of profitability, months where I was losing, back and forth over and over. By the end of the year, I had made a little bit of money, but nothing significant, just a couple of percent. And finally, in 2020, I'm profitable. So to answer the question, mind, it took me just about 2.5 years to really be profitable. Through a 6-week period I was running, starting in about early February, I grew my crypto portfolio by about 6%. I was running this test with a $10,000 portfolio, so over a 6-week period, I gained about $100 a week on average. After that, Bitcoin took a huge drop in price and I ended up buying a bunch more, so my test was over percentage-wise. Now keep in mind that Wall Street traders actually shoot for about 20% in year-over-year profit. So 6% over a 6-week period was actually phenomenal. I was running hot in my trades. Question number 9. How do I know when to enter and exit a trade? There's really one simple answer to this, and it's to have a trading plan and execute it. Before I enter any trade, I have predefined entry and exit zones. Now, personally, these map up as such. I set my entry just above major support lines when I'm day trading. This is because I know that there are algorithms waiting at these support lines. So I'm trying to buy in just before them, and then their buying activity would hold up the market and continue it back upwards as I'd expect. The stop loss of my trading plan is always 1 to 2%, and my profit target is always 2 to 3 times that number, so that my reward to risk ratio is between 2 and 3. This is the number I really shoot for. So once I'm actually in a trade, I don't have anything to think about. I set my profit and stop loss as my trading plan specifies, and that's it. I let the trade go. There's no need to make your trading plan complex. If you have an advantage in the market and you can find a place where the market is consistently rebounding, just let your trading plan play. Let your advantage run over a huge sample size. For comparison, think about casinos. They might only have a 2 to 3% edge in one of the games that they run, such as blackjack. However, if you run that edge over millions and millions and millions of hands, casinos always win in the long run and make tons of money. Question number 10. What's the best way to log your trades? To this, I'll tell you that you absolutely have to have a trading journal. In the journal, you should mark the day you entered a trade, the day you exited a trade, what asset it was, what your position size was, what your entry and exits were, how much profit or loss you had on the trade, and what the percent gain or loss was. You should also take these numbers and turn them into a P&L chart that you can see over time. And you should see that your wins are much larger than your losses, even if you have way more losses than wins. This is what a good P&L would look like. Now, if you want to do the work and create a spreadsheet yourself of that, that's great. I also have a template that you can click in the description below, copy it, and you'll have one for free. You really need to document every trade you make. This is super important. Seriously, do it. It takes an extra minute or 2 on each trade you make and will make a huge difference in your trading. And finally, the bonus question, number 11. What's your current outlook on the S&P and the market? Now, to answer this question, I'm going to show you a couple different charts. The first one here has a simple support and resistance lines drawn on it. These 2 blue lines are extremely significant over time. You can see this one is resistance here, resistance into here, resistance through this area, support and resistance all through this area, and resistance through this area. So if we were to come back down to this blue line, I would expect it to be support. This blue line does the exact same thing, as you can see in each of these places over the last 2 years. The next thing I'll draw on this chart is just a Fibonacci. So just zooming into this area a bit, let's draw a Fibonacci from our May lows here, the 2770-ish, up to the high up here, and you can see that we're actually on the 50 right now. So it is possible that we rebound here and continue forward. You can also see that the 618 lines up perfectly with that blue support and resistance line I drew. This is known as confluence in the market, and if we were to come down here, I would absolutely expect a rebound of some sort. So these are the 3 spots I'd be looking for the market to change and go back upwards after this massive move downwards. Next up, I'm going to show you an Elliott wave count I have on this. Now, I'm going to keep this super brief, but I basically have this move right here as an entire correction of a bear market, the 30% dip we had. From there, I'm looking for a market to go back upwards, and I have a 5-wave move up to this peak, which I'm labeling our A wave. After that, I have this move in here from April 29th down to May 14th as a small correction before we're continuing upwards once again. I'm labeling this move our impulse, and I'm expecting our 2-wave to fall somewhere in here, which aligns very well with our previous chart that I was showing you. After that, the count has us going upwards much further. Now, my personal favorite count has us coming up somewhere in the 3800 4,000 range before we continue downwards much more. That's because if you just zoom out on this chart and look at the time of this correction, it's incredibly quick versus the 10-year bull market we had. I really don't believe that this couple month period is going to be the full correction of this entire move we had. So I think there's going to be a significant amount of time more before we have our final correction in. And just looking where this might fall, if we pull Fibonacci from all the way back here, our 09 lows, all the way to the top of where this market ended up running to, this 618 is somewhere where I'd be looking, right around that 1700 line for our correction to finish. So those are the 11 most common questions that I've answered. If there's a question you have that I didn't answer, let me know in the comments below. Thank you so much for watching. If you liked this video, please do click the like button and consider hitting the subscribe button for future content. I hope you learned something today, and I'll catch you guys next episode.